New SBA 7A loan rules and guidelines up to $500,000 is included in this package, and helping more underserved communities, minority, veteran, and women-owned businesses. I will be getting into all of the juicy details here in just a second on what this all includes and what it means. As you see on your screen as I'm scrolling through, we are going to get to the juicy details that I put together here in bullet points so you can better understand what this means, what changes are coming, and how to better prepare if you're trying to go after an SBA 7A/504 loan. And if you're looking at the Community Advantage pilot program that more or less is there, continuation of, and then ending, and then transferring over to another service where people are getting licenses and these lenders and what that all entails. But before I do any of that, my name is Michael with Viral Funding Solutions. I'm a business funding expert, business loan broker expert, pre-underwriter/underwriter who's helped out a lot of people get an SBA 7A 504 loan, other types of SBA loans. Not only those, but I work with all suite of services with startups, anything from forming your business plan, the structure of it, understanding the cash flow, hypothetical cash flow projections, knowing those numbers, crunching them together, understanding the X, the Y, the Z's to it, anything from startup, putting that together, and then all the way up in the middle, all the way to the top to the SBA loan. So collateral, cash flow, revenue, income backed, equity, liquidity. I do quite a few things, help people improve their cash flow, profitability, and in other areas, mitigate expenses, really understand how to restructure things if they had to. I run multiple businesses myself, so I know the situation when it comes to being a startup and when you're not in the startup phase, how to continue to grow. I run a digital marketing agency, lead generation business as well, health affiliate marketing business, helping out a lot of people with vitamins and supplements, ergonomic desk chairs, back seat cushions, one underneath me. You can't really see it right now, but here it is right behind. I have others in the vertical of affiliate marketing, other ventures, and this has been my primary focus and mission for a long time as a funding expert. So just so you know, you're in great hands. I'm the analytical type. I'm more of an introvert, and that works to your best interest because I'm more reserved but very knowledgeable. I'm very punctual and disciplined, very loyal. You don't have to worry about that. Very well balanced. I'm a Libra. I'm more of the intellectual, cerebral type. So I review a lot of documentation every single day. I did that just a little bit earlier. It is a Friday as I'm putting this together. So I got away from that because it wasn't too heavy, or I moved some of the things that I'm going to have to do for tomorrow and then on Monday. But I look at a lot of documents, bank statements, tax returns, P&L, and I'm going to get into what all that has to do with parts of this service. So over here, if we go back into the screen, it's going to be a little bit easier. And this was something that was in the works for a couple of months and then has been into effect in August 1st. So as we scroll here, let's go through some of the things that are going to be uncovered. So on May 11th and May the 12th, the SBA made a series of changes to the SBA programs, and we'll get into some of those and what the parameters are. But it's going to be more lenient. This is going to help you streamline the application process much faster. The underwriting guidelines are going to be more flexible for specific lenders, non-bank lenders, and it's going to help process the applications, the loan package. And those are things that I gather from you and very many others. Is I gather the loan package together and I understand the documentation. How to review it is more important, but more important than reviewing documents, because I do that very, very well, is understanding how you use your funds. Obviously, you don't want to have to get yourself into a predicament now or later in the road, even if this is more of a lenient underwriting process, because no longer do they have to use exactly the SBA criteria and guidelines. Every single lender, the banks specifically, need to use it to be able to underwrite correctly. They might have their own underwriting, but it's not too far in between. So don't think that it's going to be this completely new mix-up where now you can just go get an SBA loan with minimum requirements, but I'll go over some of the parameters on that. So it made a series of changes to the SBA programs that helps and expands which, quote unquote, I wanted to be specific there. So you see that lenders can get licensed for, so let me put this in bold and then underline it. SBA programs, we'll get into some of those here in just a second. Establish new growth and opportunities through the Community Advantage nonprofit lenders, the Community Advantage SBLC license. I don't want to bore you with all of that. There's a lot of details there, and what I've been speaking to on the back end, but it's quite a bit. But how there are more people who are in the Community Advantage pilot program who will be then moving over and transferring over to now this other service. And this will be very helpful because it will create much more of a driven mission for your for-profit business or nonprofit business through things like the Community Advantage lenders. And it's going to be a lot more mission oriented. So if you didn't have the credit worthiness or in some format, some certain documentation, they wouldn't necessarily approve you for in certain credit requirements. But these lenders are going to start to focus more on the underserved markets, including anybody who's a startup and anything that would be classified like normally underneath 2 years considered startup, pre-revenue or low revenue, having a hard time, underserved areas and communities, veteran and women-owned businesses. And then the CA lenders also work in rural and other types of communities. That'll be very helpful, especially in the low income. So let me kind of continue to go on through this part, and then we'll go through more of the material. So the criteria is changing. That's another thing which lenders can get licensed for, to update the criteria on their behalf. That's why you're going to start to see also more fintech lenders coming into the industry who will be providing with more options and underwriting underneath their own criteria to update the underwriting process, as mentioned, to streamline your documentation and loan package or loan packages, depending on how many different clients and what needs to be put together. Everybody has a different situation, and your industry will also have some conflict, and not always bad, but it's a hard market right now. We're trying to become more lenient, or I should say the SBA, and helping to get better and higher approval. So this will also help a lot more people get approved eventually. So non-bank lender, fintechs, those who once helped in the PPP process and more, think of those. Those are the ones that are going to be coming in, not to start naming all of them, but that's a little bit, and we can discuss that over time and what would be the best approach to go through the right lender. So the overall result, this should help more businesses, even struggling ones, attain an SBA loan, qualify for an SBA loan. And it's been once very, very hard. I'll go into some of the factors that would go into getting approved for an SBA loan, but it was once, and it still can be very difficult. But a lot of the factors that came into it are reduced to about 3, which I'll get into. But the ability for you to make your loan repayments was a huge thing. Character and your credit history factored into your credit worthiness. So the borrower's character, their eligibility to make the loan payments exactly how they were supposed to be made with no hardship. There's a few other things in mind there. Collateral, over 85% of a lot of the time was collateral coverage, and it could be still in some cases, and what the SBA lender is required to take. And for the amount, maybe up to 150,000 now, no collateral is needed, or there's just a small fraction of it. So if your home was something that had equity in it, or if you had investment real estate, commercial real estate that you own, if you had these things also free and clear, how much equity is involved. So you also have to think about the hardship that the lender will endure when they're factoring collateral. But for the most part, in your projections, we're going to get into that in a minute. But what does that have to do, and why does it look different instead of having historical financials? What is the changes that are coming about? It's also based on experience, and experience is still a huge indicator. What I'm seeing right now, though, when it comes to an SBA 7A loan, and I've seen people go through this a lot, and I've helped out a lot of people, is it's still based on experience and equity injection. Maybe it is more lenient that there is a 10% down, and then post-closing and these other factors, projection costs, all factored in to the percentage as a startup. So you could see a 10%, and that 25 to 30% equity injection, like I've stated for so many people, where that equity injection comes from is if you don't have any previous experience in that industry. So if you're just getting started, or let's say you're opening up a new location, or it's a new entity, you've had previous experience within that industry, you're opening up a new location, your 4th or 5th location, and you show a proven track record. What have you done in the past? Has there been some bumps up and down in the road? How's your cash flow? How's your profitability? How's your debt service coverage ratio? These are numbers and cash flow analysis I can do on my back end. And I'll get into some of those numbers here in a second, but let's go back into this topic, or this document, excuse me. So that's a bit of it. And past, let me just mention this before I go any further into this. Invested equity is still a proportion of it, and that can play a major role now more in the projection of your cash flow, projection of your profitability and revenue, and more. And that will give us an invested amount of equity we'd have to attain. Past and future financial statements, that's still a good key indicator, but it isn't like it was once where you have to have it historically high, and historically meaning everything in terms of revenue high enough. You have a few key indicators that show us you're making enough money. Gross profit margins are there. How's your revenue trends? Is it still going up? Has it been going down? I'll get into some of the fine point details. Profitability, is it growing? Is it stable? Is it on hold? Has it declined? Why has it declined? Has it flattened? Or is it like 1 year that's negative? How are you growing? Why is it declining? And it can be more projection based, but you'd have to have a good reason for why it is the way that it is. So what's the potential that the business will succeed? And that is also predicated on the projection. What's the strength of the business now currently? What could it be? And I'll get into what that's dropped. So there have just been 3 that has dropped. That's based on credit, cash flow projections, and still collateral. And I'll get into that in a second. But those factors have lowered, allowing people to come in and have a quote unquote smoother process. Community advantage lenders will and can permanently expand serving the minority communities. So as I mentioned before, veteran, minority, women-owned businesses, entrepreneurs, those of you who are underserved in a community, in a location that you've been impacted and you have a strong enough reason and a mission to continue forward, there will be more emphasis on that. You'll see more non-bank lenders, as I mentioned earlier, that can offer SBA loans. We can get into fintech companies, which expands to funding for underserved businesses as long as they have the proportionate and given licenses. And I spoke a little bit about that earlier, and there's a lot more fine details to that I don't want to bore you with. I have a great understanding of it myself. The lenders, they benefit from saving time on the loan documentation, which allows a more streamlined journey or a path to getting SBA loans approved for you. And again, it isn't like to say that everybody will get approved now. There are some things that's on a per case basis, and I need to understand the reasoning behind if there's something here or why is it the way that it is. And there's specific industries that still have troubles going through it, especially in SBA 7A/504 type of situations. For SBA 7A loans, lenders, they have more flexibility now in using their own underwriting guidelines, as I said earlier, and the approval process as opposed to just using the SBA lending guidelines and criteria. So this is a big up right here. Let me go ahead and put this even in higher, or the, what do you call the size, excuse me. So the guidelines in the approval process, as opposed to just using SBA lending guidelines and that criteria that all of them would want them and have them using, and no if and or but about it. Now it quote unquote becomes more lenient. So it may reduce or eliminate down payment requirements for some of the borrowers and cut or reduce completely the chances you have to put a lien on your home or other forms of collateral. As I mentioned, what kind of business assets, personal assets, they look at the assets where there will be any kind of liens, blanket liens on it. If not, okay, up to what amount? Up to 150, anything underneath that. If they were to take that, they still have to take an invested interest in equity if they had to. So they'll probably put a lien on things. So some of this stuff does change, but keep in mind that a lot of this for SBA 7A loan specifically is up to 500,000. I know the program goes up to 5 million. I've helped out people get more than 500,000 in this, and recently as well. And then there's a mix of this content as you're seeing here with SBA 7A, the Community Advantage, SBLC, the licensing behind that, and a few more things. So the new rules will now allow for up to 500,000, as I mentioned, in more of a relaxed or intended lenient standard way. As the rules have changed, instead of the previous government guidelines, as I mentioned, that they have to strictly use what the SBA's lending criteria is, and they'll still make a very educated understanding on this and decision. And just so you know, I work with the best lenders in the SBA lending space. So your bank or other banks may have a hard time underwriting your process because of outdated processes, the communication with the underwriting and then the lending department, and then the final part of the process. I know that I've seen it before. I know how it all works, seen it firsthand, and a lot of people having difficulty with that. And then also liquidation, a lot of problems already with certain banks, and trying to migrate and get away from that. And so it's so redundant, and you might not have the person behind underwriting it correctly, or it's something more old school or of an old school underwriter that is not up to date with the standards or what would be the market situation for your industry. So a lot of people turn to me to really understand which lender is best suited for them, and I have a variety of them. And once I know your industry, once I know cash flow analysis, profitability, this is here, then I'll have a better understanding of which direction to move into. So there will be more diligence and an emphasis on your loan package and profit forecasting than historical financials. This is the key component to all of this. If you walk away with anything, this is it right here. And I'm going to put it in 24 size and have it in red. Excuse me. So there will be more diligence on emphasizing how and why your loan package is the way that it is. And I do this a lot, not only with SBA loans, but I collect loan packages, and I really understand, like, I can help you with cash flow. I can help you put together that document, that template together for you specifically to your industry, and what numbers would need to be added, what assumptions. I'll get into some of that in a second here. But the loan package is most important to understand. What do you have currently? What could you have later on, especially now that we're looking at it from a cash flow projections point of view. So it is very important at a part of the process. I may ask you in the beginning to have this set up already, or as we go in the beginning in initial stages, as we're reviewing credit, soft pull, and an internal house, we can look at these things. And then after that, come out about, okay, what are your sources and uses of loan proceeds? For one example, give us a 2, or in cases we'll want a 3-year. If it's 3 years, a lot of the times it's because you're a startup, you have a business plan that we need to check in this case from a specific angle and point of view. So 2 to 3 years at times. Other ways, if you're already an existing business who's having the right cash flow projections or has the right cash flow existing, and you're not underneath the bar, or your profitability is right where it needs to be, and if not more. And there's other circumstances because of industries, credit, and other requirements that we will ask for a specific amount. But we would like 2 to 3 year detailed financial projections with assumptions. We need to know that what would assume to happen if X, Y, or Z, and or, for example, how many customers per day times your average cost. That was one quick X, and here's why. Customer per day times your average cost equal to, and then you come out with a little bit more. And there's more fine details that I can help you with in time to really understand how all of this will be packaged together. So that's one part of that. Now, instead of using the 9 factors, as we mentioned, there are 3 now, and that's projected cash flow for your business. Here, let me move this. Actually, I'll leave it like that. Put into your loan package. If projection based, we need to understand the projections. How did you come up with that? What was the numbers? How did you come up with that? Does it make sense from us on our end? Would it make sense for your end now and later down 3, 6, 9, 12 plus months? What happens in 5 to 10 years? Can you repeat the process within 2 to 3 years to give you the same outcome, or a better one, or a stronger one? And if you were to dip, we want to know that as well. We want to know the story of why is it this way. If we looked at your current cash flow and it is the way it is, and it was better this year than it was last year, why is it that? And we're considering your file, like, why, what made it jump? What made the difference? And I'll get into a little bit of that for an example. And also the collateral on projection base could be more important than anything. So there are cases where we are not required, or we won't take invested equity or specific liquidity and a high amount of liquidity in cash on hand and in the banks. That's still as important as it was yesterday or before this was even made, is that liquidity factor, because of post-closing liquidity. And you want to have enough money in the bank or banks or into your account to service the debt, but not only service the debt, but two, to have enough money for your existing project and projects, to have enough money. We don't want to eliminate any of that, and you don't want to have anything reduced or very little. And when we think about what can we offer you, there's really nothing there to help you. So collateral on projection base could be more important than anything nowadays. For a startup or business that is struggling, we still want projections, period. Business plan. What do you project is going to happen when you take this situation and what money? And we want to know the details, but we also care about the numbers. I'm a numbers guy myself. So if I look at them and I think you're currently not there, what makes us think you'll get there? What have you shown us? And I've always spoken about pattern recognition. So if you have an opportunity to get a new lease or you're moving into a new location, what happened in the past location? How did you come about getting into this new one? Why did you have to move over? Your lease was up or this happened. You're moving into a new location where there's a warehouse next to it. It's closer location and you need to service it much faster with your production. Well, what showed us in the past that you were able to do that effectively? If not, you added a new thing to your services, and what makes us think that you'll be responsible to handle the growth and revenue of that? So there are a lot of little things and minute details on our back end that you don't see that I get done with my team. So as that said, for a startup or business that is struggling, we still want projections, usually 3 years. In most cases, 2 to 3 years. 3 years is a lot of the times what we see for startups because you are a startup with non-existing revenue. But if you've had a track record and the experience comes in, when you get 10%, a lot of the times, like you're in the same industry, you're operating underneath the same industry, you're opening up a new location, a new LLC, you had to move things for certain reasons, you have new ownership or whatever you're taking over, you're buying a business. That's a whole nother topic, but it has to be relevant and make sense unless doing 25 to 30% equity injections come into the play there, or there's a few other underlying outliers that we looked at and that had to make more sense to go up in a higher percentage. Maybe too, depending on the file and strength. Here, oh, there. Maybe too, depending on the file and strength, as well as more. So as I mentioned previously, if we had to look at two, could it be a non-startup or a startup? It just depends on industry, depends on where you're at now, pre-revenue, how long have you been in and why you haven't been making any money. There's quite a few boundaries to a lot of this. Credit, we preferably would like 675. Can we go at 650? Yes, we can. That is a place to look at. And I'll get into a little bit how 650 credit would make sense as opposed to 675. But collateral, it's still a factor, but we may not take collateral up to 150K, let's say, or we will factor it in. We'll look at what invested equity, just put at least a blanket lien if we had to, or if the lender would take the collateral because they really needed to make their money back. You're already thin on the personal side, okay. But when you have a home with invested equity under investment real estate, etc., to recover from, that can be questionable. Notes, if you have 650 plus credit and with like two consistent, let me put the end there, excuse me, with like two consistent back-to-back years of negative cash flow, you are already in the red zone, and that is not good. So you can't make a good case if your revenue isn't in line, if your gross profit margins month to month, and then we see your overall net operating income at the end of the year, we factor in everything. True profits of the business, by the way, everything factored in, taxes, everything. EBITDA putting back into the cash flow, other things, that's for other purposes. But if you're in the red zone, that's not a good sign. So if you have 650 credit and you're like, why am I not getting approved? I heard that it can be dropped. But you have two consistent back-to-back years of negative cash flow, or you're just barely resurfacing, that isn't any good. Your profitability isn't in line. Other factors are not there that we're looking for. Perhaps it was a collateral part that it just wasn't enough for your specific industry. You're in the red zone. That is not good. 650 plus with a strong case in cash flow over here and projected cash flow. So that could mean a variety of things. That could mean, hey, you went, let's say, for example, 2019 wasn't any good. You had a COVID year, or 2020. And then 2020, it was not good either. Okay. 2021, it's better, it's increased, but by how much? What's the story? What's the why behind that? How did you change things? It's more important to know that. And then 2022, it is better. What did you do to change that? What did you do to get back on track? And so when I look at the tax returns, when I look at the P&L balance sheet and debt schedule and a lot of this, all I have a better understanding. Oh, you cleared up a lot of your utilization in your debt. You had a personal loan, or you had other business loans and advances, you cleared up. and you increase your cash flow. And so that could be a big indicator. It could be equipment that you sold, leases that you are keeping your cost low, that you're leasing on, and you remove the property, you move to a new location. There could be a lot of things. It could be a ground up construction project that's allowing you to then increase your cash flow. You're holding on to certain things for an extensive amount of time. But there's a lot of little situations to understand there. And that, I hope you can interpret that as in what we're looking for when it comes to having a lower credit score. It's by case basis. And projected cash flow there. The DSCR, debt service coverage ratio, we can look at things globally, personally, and in business. I look at a lot of this stuff to determine. And so normally you want a 1.25 DSCR, or even a 1.15 could work. I've seen that with online bank term loans, but shoot for a 1.25. That's normally the standard. If you have a story where let's say you had a 0.30 DSCR, debt service coverage, let's just say that, and then you went up the next year to about a 1.0, that's looking better. I would like to see that closer to a 1.12. That would be better, or 1.15. But what did you do? I need to know the story when I do my cash flow analysis, if this is even credible, if this is something that can be worked through. And if it isn't, what measures need to be taken? Because there's quite a bit when it comes to understanding your net operating income. It's not as simple as just doing a division problem. I got to do a lot more. And I have to understand what's your net operating income year over year, and what's your annual debt service. I do more calculations, year over years, averages. I look at other numbers, current operating cash flow. I break it down even to a smaller scale. And so there are those things that I'm looking for when it comes to benefiting from having the right DSCR. So must have 650 plus credit. If that, is there any profitability? Okay, if there is profitability there, we look at it too. That's good. All right. So we will still review collateral, cash flow, credit, profitability, etc. But you have to account for how much profitability. Why weren't you profitable the last year? Why are you on track this year? The year before that one you were, but the middle one you weren't. Why was that? Oh, it's a good enough reason. Not a good enough reason to say you were sucking up a lot of cash flow or a lot of these cash advances. But why did you take those advances if that's not a legitimate enough reason and you knew better? You had collateral, or you had this other thing that you could have done. That's what we want to understand more of in the numbers, especially that. So example, like I said earlier, 2019 equals good, 2020 equals not good, 2021 equals better, 2022 you improved. Question though, like I said, what did you do to change things and how will it hold up? It's not how do you just change it or what did you do to change it, but what are you going to do to keep that in the same position? And also increase that. If you have a reason to increase it, you go in 3 years, I'm going to secure 2 to 3 contracts because I'm on contract now with certain providers, and whether they're going good or not, and you're looking at getting new suppliers, vendors, you're going to get more inventory. Inventory is increasing. Okay, what does that do to your cash flow? There's a lot more things. So 2022 equals no revenue, little revenue for relocation and or construction. It could be a variety of other reasons. But in 2021, you were good, strong revenue with cash flow. And when it was up, it was increasing. I saw the amount. And then 2020 equals good revenue and cash flow, or drop in cash flow a little bit, or however much it dropped. Not too much fluctuation year over year and months over months. So that's where I break it down even to a smaller scale. And that's where I'm going to leave it at. But that gives you a good indication in a bar to kind of go off of things. And here's just a little bit more details. If I move this document over, you can see more of the SBA here when it comes to the lending company SBLC, as we just mentioned earlier, the moratorium rescission, and removal of the requirement for a loan authorization. And there's more indication right here. This rule, how it was effective in May 12th of 2023. And I already went through all of this myself just because I need to know this and I need to understand it in depth. But that is another part there that we're not going to go into so much. And you can see here's another one on the affiliation and lending criteria for the SBA business loan, a rule by the Small Business Administration on the 10th of April of this year. And there's a summary and more information, and not a lot of it that you really need to get into on your side, but just know that it is there. I guess just a few closing thoughts. There are SBA loans, some more that are growing, and then others. And then you have a lot of money that's been left on the table, a lot of money, and millions upon millions and even billions that should be in getting out there to be dispersed and for increases and things like that. For SBA grants, I'll leave more information down below, but there's been an increase in that. And with the whole change within the Community Advantage pilot program and more of these fintech providers, and you're seeing more with CDFIs and contributing into this whole factor of this process, it's going to allow more room for people to get not only grants, but to move up into these startup backed, community backed programs even more precisely and located within your area. And also for the SBA 7A loans and 504 loans to take a higher increase. You're going to be seeing a lot of that. And if I didn't mention this, I did say it a little bit earlier, but you're going to see the SBA issuing you, or not you, the lenders, at least 3 new lender licenses, and to these fintech companies likely. And this is an effort to increase their options that they can give to business owners and yourself, small business owners, more than anything, when you're looking for different types of funding and more flexibility, which is going to also increase a lot of people going through underwriting quicker. The competition, it's going to grow immensely as more licenses I would see getting distributed over time, and more people having this power to allow people to get different SBA loans and getting dispersed the money that they should be getting. That's going to increase. But there will be a lot of money there to give out. And I think that's everything I want to cover. I have a few other things here. Let me make sure that I covered it. And one other piece of content that I do want to make sure you have is the CDC, Certified Development Centers, community-based nonprofits are out there. So those are another place to go to. I'll try to leave more information. Microloan lenders, I've helped out a few people with those recently. I've created content on that. I'll try to link it to you down below, but I'll also try to have a grant document where that information will be in there. But CDFIs, as I mentioned a little bit earlier, community-based organizations, and there's just a little bit more that I had already previously mentioned that I won't get too far into at this moment. So I think that's where I'm going to end this video. And so you got a good understanding of what's being allocated into different programs, what's being put into effect, how much can be offered for certain ones, minority business owners, women's or veterans owned businesses, and just a little bit more. If you would get declined for an SBA 7A loan, there are other factors from other, like the Community Advantage pilot program, probably not being into effect after next year or so. But now with licenses and with fintech lenders and having that room to go through an underserved community that they can help you with, that'll be there. So I think that's everything. Let me make sure I covered it all. I'm not going to go into all the details on the Community Advantage program that was once previously, but if you were a startup and you were considered underneath 2 years, that's what they would look at. And then in certain underdeveloped areas, you have rural areas, and there's other ones there specifically. And I've created content on the Community Advantage program. I'll try to, again, link you to that down below in the description. As I'm looking in here at my other document on my other tab, I've covered everything that I needed to. Let me see if this one, no, that doesn't need to be over. Okay, that I covered, showed you a bit of that. Okay, so I'm going to backspace here, come back to the document, and just quickly let you glance at it to make sure you see it's all there. But we went over all of this right here, and I'm going to need to understand more about your situation to get a better feeling of if this can or can't work. And I guess the last thing I want to end it with, and I had a few notes here. This is what I want to mention, and I put it actually on my notepad here. And as I was going through things today, there are people who are trying to refinance, and this is a whole completely separate topic, but I'm going to end it with this. If you're trying to refinance debt, let's talk about merchant cash advance, hybrid cash advances. If you're over leveraged, like let's say 6 to 10, even less than 6, and you're trying to refinance underneath an SBA and consolidate, they're likely not going to help you. Even if it's a couple of them, it just depends on how current it is. It's not normally a percentage that if you paid 50% of this and that. A lot of the times they would like to see if it's paid over 50%, closer to 75% plus, then a refinance situation will be best. It's not to say that that has to be it, but it's also based on current cash flow. So if there's a specific business owner in their business and their industry where we see already the returns on their investment, we see their current cash flow, their annual debt service, we look at it and say we can't issue them a new loan at that amount and then have them run into problems having to refinance their existing debt. We can't do that. There's not enough cash flow. One, there won't be enough projection cash flow enough to service all of this. So it's on a per case basis. Others can get through with just a little minimum amount, 40 to 100,000, 20 to 100,000 in one position or more or less. But it's also dependent on like, what else do you have? What can you do? Can we invest enough into this project? Can we seize this if we had to? So there's a little bit of that. And I spoke about it a little bit right here. 1 to 2 is still not good. And it just depends on the amount. Like I said, 6 plus, it makes the SBA lender nervous, even with online bank term loans. And those can be somewhat more lenient because of cash flow analysis. But if you're already having decreasing revenue trends, you're fluctuating so much and your cash flow isn't in position. And what we look at with the current market, we look at your industry as well. We determine in this location, this is this. Okay, well, it's not. It's underserved right now. We don't want to take that chance that we're going to fall into problems. But if you're just taking on like an SBA loan, let's say, for example, and you're using then that money to pay off other advances, or you're using, you're going to go even worse, is you're going to go and apply for more funding, like advances. You're going to pile on 1 to 2, or you need to refinance and you need to figure out all these other methods. That's going to run you into a lot of problems. And so the question becomes is, why are you borrowing so much money? Are you biting off more than what you can chew? And we have to work on that and think, do we need to move back? Do we need to stick to what we're doing now and then grow and expand later on? You're taking on too much. Does all of that even make sense? So if refinance, I cover that a little bit. Cash flow, how much would be projected, especially if you're with tight credit. If you're trying to refinance and do a lot of this, you're in tightened credit, personal and in business as well. That makes it also difficult. And if you're taking debt to pay off bad debt, how much of a percentage? And that's not also a good indicator of future growth and cash flow and being able to service the existing loan that you would be, the loan that you would be proposed to be given. So I kind of go into the DSCR. This is a whole different topic. I spoke a little bit about it earlier. This goes into more depth, but I won't do all that right now. If refinance, at what amount? Why did they take it out? I need to know the situation on like the advances, why those were taken out. Why did you need it? That's more important than anything. For startups, I went into that a little bit with eligibility on percentages. So not intended for 150K. I mentioned that a little bit earlier. And another thing too is when an SBA, with the SBA lender and the SBA does an audit, because that will and can happen quarter per quarter basis, you'll see it, then is your position in the right place? Are you closer on the verge to defaulting? Because if there was an issue, maybe with like a lease agreement or something else. And I just mentioned one example. There are many more here. So that's a little bit there. And if you were to default, that's a lot of issues of what they could come after on the business, on the personal side. What's not. And then also making sure you do a loan modification if you had to, had to change things, stipulations, or things need to be changed where you can make those payments. If you're finding financial hardship, to seek out the lender, communicate that with me so that I can be able to help you and make a better case with the provider. And it's all about having that relationship. And that's why people prefer to work with someone like myself, because I already have the best lenders in the space for each and every service. I have the best underwriters. Heck, I'm a pre-underwriter / underwriter in that sense, that I can fully just become an underwriter. But for flexibility and for other reasons too, is I'm on this side of things. Although, like I said before, and I've said it before to those of you who have been watching me, I can just go 100% into underwriting. That's just how my brain works. But there are many other good reasons and pros and cons to this, and having to be on schedule for this on 9 to 5. And there's a lot of other things you have to understand on this side of things. But it's just for me to get a better understanding. And I'm going to leave more information to a lot of this down below in the description. Hopefully you got great information from this. And there will be a questionnaire form for you to get started. It'll be down below. If you filled this out and I haven't responded back yet, I'll get back to you in time. I do get quite busy and flooded. That's okay. If you want to work with an expert, patience is a virtue, and that'll pay off in the long run. I know that for sure. I've done that so many times and I've helped out so many people. But if you have received the response from me, then that's a whole nother story and how you've moved forward. And if you haven't, but I value feedback, I value patience, I value the open mindedness, and the character of the person matters immensely to me. So having the standards, having the right morals, values, beliefs, aspirations, how you go about things, not only in your business, but in your personal life, that has a key indicator in me helping someone, because I don't want to be energy and time inefficient and or be stressed out because of certain problems that didn't need to arise, or the way they were aggressive, they shouldn't have ever been that way. So I need to protect myself too and be cautious of that. And even if you are that way, not to say I wouldn't help you or work with you, it's just, can we leave that out the door? Can you not bring that friction and resistance in here the way you are? Can we completely reduce and eliminate that? Because that'll also affect our process. And so I value that. I've worked on myself for quite a long time, and that's where I want to leave it at. But again, all information down below in the description. If you found value from this video, please give it a thumbs up, share it with others who you feel will find value from it. It can be a complete stranger, a friend, or a family member, but you know, at the end of the day, you were able to help them out and pick themselves up, whether they're trying to get an SBA loan or not, or do things with other things that are underserved communities, minority-owned businesses, women entrepreneurs. You have veteran-owned businesses and more that will free up some more breathing room. And if you even know of somebody who needs financing for that case to be made too, and you want me to help them, I can help you too, and I can help you in that case, and we can come up with things and what would be the best scenario. And here's what I would recommend doing, this for this service and this for that service, and here's how I leave it at. And there's no room for that, but it's very justified, and I'm very reasonable with everybody. And if you haven't subscribed, please go ahead and subscribe and click that bell notification icon so you do not miss any future content I will be coming out with. That is all for now. Take care.